Welcome to Financial Freedom FX. Today we are talking in candlestick pattern. Alright, so let's break down this incredibly useful cheat sheet for candlestick patterns. Think of it as a visual power ranking for what the market is telling you. On the left, under the strength banner, we have our bullish signals, starting from the strongest and moving down. The Marubozu, a strong-bodied candle with no wicks, is at the top, showing pure buying pressure. As we move down through the hammer, bullish spinning top, and doji, the signal gets progressively less bullish, suggesting the buyer's conviction is waning. Now flip to the right side for the bearish warnings. At the very bottom, we have the most bearish signals like the bearish Marubozu, indicating strong selling pressure. As we move up through patterns like the shooting star, bearish spinning top, and the various dojis, the signal becomes less bearish, meaning the sellers are losing their grip. This chart is essentially a spectrum helping you instantly gauge whether the bulls or the bears are in control and just how strong their conviction really is. Now, this second image is a bit more chaotic, and that's the point. It's simulating the noisy, often conflicting signals a new trader might see in a live market. Unlike the first chart, which was neatly organized, this one is a jumble of candlestick patterns with buy, sell, and indecision labels popping up all over the place. The key takeaway here is the danger of looking at patterns in isolation without context. For instance, you might see a gravestone doji, which is typically a bearish sell signal, but right next to it, the chart confusingly says buy. Similarly, a doji, which usually means indecision, is sometimes labeled as a buy signal. This image perfectly illustrates a critical lesson. Candlesticks are not a standalone magic bullet. A single pattern, like a hammer or a three white crows, can be misleading if you don't consider its location. Is it occurring after a steep decline or at the top of a rally? Without the context of the broader trend and confirmation from the next candle, you can get whipsawed by false signals, buying and selling at the wrong time based on this kind of random, unconfirmed noise. This third image, titled Rising Sun Candlestick, gives us a perfect, clean example of how to correctly use a single candlestick pattern within the broader market context. We see a clear downtrend, indicated by the descending line and label, showing that the sellers have been in control. Then, right at a potential turning point, we see the rising sun candle form. This is a classic bullish reversal pattern, and the chart correctly labels it with a buy signal. But it doesn't stop there. This is where good trading discipline comes in. The chart also explicitly shows a stop-loss level, which would typically be placed just below the low of this bullish candle. This entire setup occurs in what's labeled the bullish zone, which represents a key support area or a point where the downtrend might be exhausted. So, unlike the previous confusing image, this one teaches us the right way to trade, identify the prevailing trend, downtrend, wait for a reversal signal, rising sun candle in a potential reversal zone, and then immediately manage your risk with a stop loss. It's a complete responsible trading idea in a single snapshot. This image on the doji candlestick is a brilliant and simple visual of a very common and costly trading mistake. We see an established uptrend, which is crucial context. Within that uptrend, a doji forms, which signals indecision between buyers and sellers. The problem is right here. The chart shows conflicting commands. It has a buy signal, but then immediately lists sell, and even has two separate stop-loss levels, which is a clear sign of confusion. This perfectly illustrates how a novice trader might misinterpret a doji in an uptrend. They might see the indecision and immediately think sell or a reversal is coming, when in reality, in a strong uptrend, a doji is often just a pause before the trend continues. Trying to trade this single, ambiguous signal leads to this exact internal conflict. Do I buy the dip or sell the top? And without waiting for confirmation from the next candle, you're just guessing. This image serves as a critical final lesson. Never trade a doji in isolation. Always wait for the next candle to confirm the direction, or you'll be left with a messy plan and multiple stop losses, which is essentially no plan at all. This image on the hammer candlestick brings us full circle, reinforcing the correct, disciplined method we started to see in the rising sun chart. Here we have a clean and classic example of a hammer, a strong, bullish reversal pattern. The chart correctly identifies the bullish zone, which is a key support area after a price decline. It's in this zone that the hammer becomes significant. The chart gives us a clear single buy signal right at the hammer, showing the entry point. And most importantly, it clearly defines the risk with a stop loss placed below the low of the hammer's shadow. This is textbook technical analysis. Unlike the confusing doji chart with its conflicting signals, the hammer's message is clear. Buyers have stepped in and overwhelmed the sellers. And unlike the noisy second image, this one provides a structured plan. It shows us that successful trading isn't about reacting to every single candle, but about waiting for high-probability patterns in the right context, and then having the discipline to enter and manage your risk precisely. The evening star candlestick is the perfect bearish counterpart to our rising sun and hammer examples, completing the picture. We see a clear uptrend that has been in place. The evening star is a 3-candle bearish reversal pattern that typically forms right at the top of such a trend, signaling that the buyers are exhausted and the sellers are taking control. The chart correctly gives us a sell signal, often on the close of the third confirming candle. And just like with our bullish trades, risk management is paramount. The stop loss is logically placed above the high of the pattern, protecting you if the uptrend unexpectedly resumes. Notice the website at the bottom, wbullishzone.com. It's a nice touch, reminding us that even on a sell signal, the broader context of understanding market zones is key. Together, these 6 images tell a complete story, from learning individual patterns to the chaos of misusing them, and finally, to the disciplined application of buying in bullish zones with a stop loss and selling in overextended uptrends with a stop loss. It's a full-cycle lesson in candlestick trading. This image, focusing on the Morningstar candlestick, is a textbook example of a powerful bullish reversal setup, and it perfectly mirrors the evening star we just saw. The chart sets the stage by showing a downtrend, indicating that the sellers have been dominant. The Morningstar is a 3-candle pattern that appears right at the bottom of this downtrend, acting as the first sign of hope for the bulls. It's a signal that the selling pressure is exhausting and buyers are stepping in. That's why we see the clear buy signal generated by this pattern. Crucially, this buy signal occurs within what's labeled the bullish zone, a key support area where reversals are more likely to happen. And just like any good trade, it includes a clear risk management strategy with the stop loss placed below the low of the pattern. This image reinforces the golden rule. The most reliable signals are those that align with the context. Here, a proven bullish reversal pattern, Morning Star, appears in a bullish zone after a sustained downtrend, giving traders a high-probability entry with a well-defined risk point. Now, this image is like a family tree for one of the most important candlesticks we've discussed, the doji. Titled Types of Doji Candle, it shows us that a doji isn't just one signal. It's an entire family of patterns, and its meaning changes dramatically depending on its shape and context. We see basic types like the long-legged doji, which shows massive indecision with long wicks on both sides. But more importantly, we see the doji as a component in major reversal patterns. It's the star of the show in the morning doji star and evening doji star, which are even stronger versions of the morning and evening star patterns we just learned. It's also part of the abandoned baby top and bottom, which are rare but very powerful signals. Interestingly, the chart even lists patterns like the hammer and shooting star here, which aren't technically dojis, but share that same concept of a small body and a long wick, signaling a potential reversal. The key takeaway from this chart is depth. The simple doji we saw causing confusion earlier is actually the foundation for some of the most reliable reversal patterns in technical analysis. It teaches us to look closer, because the specific type of doji and the pattern it forms can give you a much clearer and more powerful trading signal than a standard doji alone. And this final image brings our entire candlestick journey down to one crucial real-world concept, the price chart itself. At first glance, this might just look like a screen cluttered with numbers, but it represents the most important environment where all these patterns live. We see the key labels buy and stop loss placed on what appears to be a chart in a downtrend. The long list of numbers like 1.5, 2.5, 3.5, and so on represents the price action, the open, high, low, and close of every candle that forms the trends and patterns we've been studying. This is the reality of trading. It's not about looking at perfect isolated diagrams. It's about scanning a live moving chart, identifying a downtrend within those numbers, spotting a high probability reversal pattern like a hammer or morning star forming, and then executing your plan by placing a buy order with a protective stop loss just below the recent lows. This image is the blank canvas. All the patterns we learned, the dojis, the hammers, the engulfing bars, are the brushes and colors you use to paint your trading decisions onto this canvas. It reminds us that the theory is useless without practical application on the real price chart.